Good morning, everyone. Welcome to our first of our Charity Trustee training webinars for 2024. My name's Keith McPherson, the audit partner with Henderson Logie, but I also head up our charity and not-for-profit work. In thinking about topics for webinars for 2024, I tried to put myself in the mindset of yourselves as trustees or senior management managing charities in what is an increasingly challenging world amid a complex regulatory environment. So today's webinar is very much about that, and it applies equally to me as an audit partner working with my clients. When there's something weird and it doesn't look good, I don't tend to call Ghostbusters, but I do tend to call my tax colleagues. So I'm delighted to have Susan Pattison and Alan Davis joining today, both hugely experienced in working with our charity clients to discuss charity trading and key tax issues. Susan's first going to take you through the kind of corporation tax and charity trading aspects and the appropriate use of subsidiary trading companies, before Alan will discuss VAT implications to be aware of. We're aiming at about 45 minutes this morning. We are recording the session so we can make it available afterwards. And the plan is to have time for a short Q&A at the end. So feel free to place questions that you have in the Q&A box at the bottom of your screen, and we'll hope to pick those up at the end. So without further ado, I'll now hand over to Susan to take us forward. Thanks.
Thanks, Keith. Hi, everyone. My name is Susan, and I'm a Senior Tax Manager based in the Dundee office of Henderson Logie. I specialise in corporation tax and get involved in both compliance and tax advisory work for charities. Trading subsidiaries and charity trading is something that we get asked queries on regularly, and it's an area where there can be misunderstanding. So we wanted to run this webinar to go over some of the key areas with you all. There's me. So the first thing that I wanted to go over was just a bit of the rationale and structure for using a trading subsidiary. So trading subsidiaries are typically used for three main reasons: to minimise the direct tax payable on trading activities, to improve VAT recoveries on expenditure or maximise VAT efficiency, to protect charity assets and reputation from the commercial risks of trading, notably particular risks associated with hazardous activities such as parachute jumps, which might suffer substantial insurance claims. It's important to be clear on what you're trying to achieve. This helps structure and manage the activities effectively. Finance is generally provided by the parent charity through a combination of share and loan capital and intercompany accounts. Trustees need to be satisfied that it's in the charity's best interest to provide financial support. So there should be a robust business case supported by budgets and plans and cash flow forecasts. Investment decisions should be self-evidently made on a reasonable basis for the benefit of the charity. And if this is not the case, HMRC may consider investments to be non-charitable in nature and therefore subject to tax. Written agreements should be discussed and put in place to protect the charity's interests and to provide clarity about how things will operate. These might include a deed of covenant to govern the distribution of profits from the trading subsidiary to the charity, a shared resource agreement to govern the shared use of staff, services and other resources, and a loan agreement to confirm interest and loan repayment terms on any loan between the subsidiary and the parent charity. So this morning I'm going to look at what income is non-taxable for a charity and some of the key principles of charity tax law in relation to trading by a charity. This will include what is trading, primary and ancillary primary purpose trading, other exempt trading activities, and non-primary purpose trading. I will also cover when to establish a trading subsidiary and some advantages and disadvantages of doing so. So first, to cover some sources of income which are non-taxable for a charity, provided that the income is used for charitable purposes. These include rental income from letting out premises held for charitable purposes, though it's important to note that income from additional services such as catering or conferencing facilities is trading income and is therefore not exempt. Income from donations, grants, donated goods is not taxable, as is the income from the onward sale of donated goods. Investment income and donations from companies are also non-taxable. Now to look at what is trading, which is unfortunately not a simple answer. So sales of goods and services is generally an essential feature, and whether activities constitute trading depends on several factors such as repetition, so carrying out the same transactions frequently or repeatedly, having a profit motive to the activities, and whether a mechanism for selling is in place, and also buying items for resale are all things that can suggest there's a trading activity going on. For example, if a charity shop sells both donated goods and goods they have purchased for onward sale, the income from the sale of donated goods is exempt from tax, but the income from the sale of goods that they've purchased to resell is not exempt. There is a common misconception that charities can't carry out any trading activities. This is not the case, they can do, but there are various rules around this. Primary purpose trading is where profits are realised on trading that is directly related to the charity's purpose. No corporation tax will be charged on profits from these activities, as the income and costs are both exempt. An example of primary purpose trading is an independent school charging students a tuition fee. This exemption is also extended to profits on trading that indirectly helps the charity's primary purpose, which is known as ancillary primary purpose trading. And an example of ancillary primary purpose trading is a museum or a gallery that runs a cafe for its visitors only. There's also a further exemption from tax available where the trade is carried out by beneficiaries of the charity. So for example, students running a restaurant at a cooking school, or a shop run by a charity that helps those with disabilities being run by disabled staff. Fundraising events are also exempt from corporation tax where the proceeds are used for charitable purposes and the event is exempt from VAT. Non-primary purpose trading activity that doesn't fall under the various exemptions will be taxable unless the amount is within the small trading tax exemption limit. Examples of non-primary purpose trading are a university renting out campus accommodation to the public outside of term time, or a museum operating a cafe or bar that is open to the public, or a charity running a shop selling new goods. Any income which is from non-primary purpose trading must be below the small trading exemption in order to be exempt from tax. This table shows how this is calculated based on the income of the charity. So if a charity's total income is below 32,000, the maximum turnover from non-primary purpose trading is £8,000. For charities with total income between £32,000 and £320,000, the maximum non-primary purpose trading turnover is 25% of the charity's total income. And for charities with income above £320,000, the maximum from non-primary purpose trading is £80,000, sorry. So if the non-primary purpose income is above the small trading tax exemption, this income is therefore taxable, and therefore any profits will be subject to corporation tax. To avoid this, the trustees could consider setting up a trading subsidiary. Once a trading subsidiary is in place, trading profits from the trading subsidiary can be gifted to the parent charity as a qualifying charitable donation, which is commonly known as corporate gift aid or simply gift aid. Legally, these payments are a distribution like a dividend and can only be paid where the charity has sufficient reserves to do so. If this payment is made within 9 months after the end of the accounting period, the amount of the payment is deductible from the trading subsidiary's profits and can therefore bring the taxable profits to nil. If unrealised profits are gifted in error or gifts exceed what is available for distribution, HMRC will disallow that part of the payment and the profits could become taxable in the trading subsidiary. As mentioned earlier, a potential advantage of a trading subsidiary is that the charity avoids tax potentially becoming payable on non-primary purpose trading by the charity. It also removes any risks from the activities into a separate entity, and there's also the option to create a separate board with the appropriate skills and experience for the trading activities. However, some potential disadvantages are that there is a more complex structure with additional costs and compliance requirements. The trading subsidiary also needs to operate at arm's length to the charity, and that may require management charges between the entities to be put in place. Another potential disadvantage is rates relief may be lost for the activities undertaken by the subsidiary. I'll now pass over to Alan, who will discuss the key VAT aspects in relation to trading subsidiaries.
Okay, good morning. Hopefully you can see the slides. Perhaps Keith will put his thumb up. Excellent, good. So good morning, nice to be with you this morning. My task this morning is to share some VAT tidbits. I'm Alan Davis, the VAT partner at Henderson Logie. I lead our VAT advisory service, and probably one of the biggest lines of service we provide is to charities, and specifically lots of time spent on the pros and cons of having a trading company and the implications of VAT within a trading company. So it keeps us busy and happy because that's such an interesting tax. So these slides move on. So I've got 4 topics to cover. VAT registration generally in terms of obligation to register, but also a focus on the nature of income that many charities have, and being absolutely clear about whether they're supplies for VAT or grants. I'll look at intergroup trading. Very often when you set up a trading company, there are staff in the wrong place, so there's charges going to and fro, so we'll pick up that. And also consider the differences that are about in terms of the legal status of a charity versus a trading subsidiary from a VAT point of view. That there are some little intricacies around that, around eligible body. And then finally, I'll just cover some of the general reliefs available to charities that are not available to trading subsidiaries. So it's something to watch out for if you're expending money and thinking you're going to get a relief that's only available to a charity rather than a subsidiary. So the first one then is VAT registration, and the eagle-eyed amongst you will have noted in the budget week before last that the threshold for VAT registration will go up from the 1st of April this year, 24, to 90,000 from 85,000 per annum. And the VAT registration test is twofold. You're required to look back every month end over the prior 12 months to establish if your taxable turnover is more than 85 currently, or 90 from 1st of April. And if you are, you then have a period to register as an obligation to HMRC. And you need to do that each month as you're going along. So I was speaking to a client last week who was bouncing along quite close to it, and they were making efforts to stay under because they didn't want to register, but there would be times where businesses and charities just keep growing, which is usually a good thing, and they then have to register for VAT. But there is a second test, and that's a rather than a look backwards, it's a look forward test. And the question that you need to answer is, will the turnover, taxable turnover in the next 30 days exceed the threshold of 90,000? And the most obvious example of that is a contract that you've just won that will lead to a huge increase in taxable income. Registration on that point is as soon as you become aware of that obligation, you register from that date, whereas in the look back, you then get a VAT-free month effectively to notify and then start being registered. And one of the other things that's important to remember in VAT terms is that there's those are the obligations to register. There's also a voluntary registration process. So it might be a case where, for example, all your income is zero rated. So if you've got sales of donated goods or books or something like that, that's at £60,000, whilst you have no obligation to register, you can register voluntarily, and you have that entitlement. The benefits, obviously, of that is that you potentially get some VAT back on expenditure, and you've got no VAT to pay on income. And the biggest kind of downside to that is the administrative cost and that goes along with preparing and submitting VAT returns, and effectively being involved with HMRC, where previously you wouldn't have been. Lots of people are scared of HMRC rather. As a former VAT inspector, I can say that the current regime of HMRC isn't the most helpful, and the cost of engaging with them can be quite substantial. So it's something to really be aware of is that if you have a voluntary position, don't ignore that potential extra cost. And then the final point on registration is really fundamental in terms of monitoring your taxable turnover, and that's being aware of what the difference between your types of income or income streams are. What we're looking to measure is how much taxable income you have, and that's the zero, reduced rate, and standard rate. And it doesn't include any exempt money, supplies that you make, or grant money or donations. And just by way of an example, we've just taken on a new client, and as part of that take-on process, talked to them about VAT, and their most of their income came from what they understood was grants. When we looked at the paperwork and the process involved, they were actually making supplies, and luckily in that instance their supplies were zero rated, so we've been able to go back 4 years and get a retrospective VAT registration. They've got no VAT to pay on the income, and they're now in the process of making a significant reclaim on VAT on costs. So it's really important to focus on what your income is, whether it'll be taxable, and how that impacts in terms of VAT registration. So there might be opportunities, but also potential pitfalls, particularly if your income might fall into the taxable standard rate category. The second part I was going to talk about was that intercompany or inter-entity trading. So the charity and the trading subsidiary, that you might have set up a trading company for all the right reasons in terms of governance and so on, but inevitably you'll end up with cross charges around typically staff. So staff, you may prefer to have the staff sat in the charity and being charged down to the trading subsidiary, or vice versa. And particularly if the trading company is more kind of active on a day-to-day basis. So it's important to focus on which way the charges are going, which entities are required to be registered or not. So particularly again, if a subsidiary is registered and has no staff, that's typically fine. If the charity's got all the staff, that counts towards their taxable turnover test if they're charging down to the subsidiary. And it's very difficult to give you a kind of a one-size-fits-all solution to that, because it's very much each charity has their own way of doing things. So it's really important to kind of get your arms around it and say, right, well, which way do the charges go? Does that give us any implications from that point of view? And one of the things that often happens then is that if these intercompany charges are quite substantial, there could be a registration requirement for one or both of the entities. But one way of removing VAT on those cross charges is to form a VAT group, which has the benefit of just literally disregarding the cross entity charges, but brings the biggest drawback of that grouping is that both parties are liable for each other's VAT liability. So if one was to fail, the other would pay the VAT. Generally speaking, that's not an issue, because the charity and the trading company are very closely connected. So you would hope that the two work in tandem. But for any question on whether to VAT group or not, it is fact specific. You need to just sit down and do the sums to find out which way is best. Because the third bullet point there points out that sometimes it's better to have two separate entities making taxable charges that boosts VAT recovery in one of them, because they've maybe got exempt income that's reducing their recoverable VAT. But so by introducing taxable charges to the sub, the recovery rate can be boosted. So the third point was really just kind of highlight the fact that the charities and trading subsidiaries are different bodies from that point of view. The trading subsidiary is really just any other normal trading business from that point of view. HMRC won't give any leeway to a body that's trading underneath a subsidiary, with two exceptions. And I wanted to focus on those, and I think they were mentioned by Susan in the earlier part about donated goods. So from a VAT point of view, the sale of donated goods by a charity is zero rated, which is good. So if you've got a charity shop selling donated goods, all their income should be zero rated. But that zero rating is also available to the trading subsidiary. So if that's the appropriate or best way to run it, then that relief's available. And similarly, a similar relief, but that exemption is also available for fundraising events. So if you have an annual ball that you run through the trading subsidiary, the sales of tickets to the ball will be exempt in much the same way as the charity, if the charity had run it itself. But those are the two areas only that what the relief that's set out for the charity falls into the trading subsidiary. In most other cases, the income will stand or fall on its own merits in the trading subsidiary. And the kind of key point there is that in VAT terms, there's a phrase called an eligible body. And an eligible body is, generally speaking, a charity, somebody who's not distributing profits to shareholders. And they qualify for lots of exemptions around cultural admissions, sports admissions, and activities, and so on, which will be exempt from VAT, but only when provided by a charity rather than the trading sub. So if for whatever reason you want to put it into the trading subsidiary, your charges for cultural admissions will be exempt in the charity, but taxable in the trading subsidiary. And the other thing, and just coming on to the more general reliefs, trading subsidiaries don't benefit from any of the reliefs available for charities on expenditure, and I'll come on to those now. And I think Susan said it, that there is no general relief for charities. You have to be kind of focused in on exactly what applies in your specific circumstances. So it's very important that you focus on exactly what you're doing and how it applies to your fact pattern for your entity. But for charities, not trading subs, 0 ratings available if you're building relevant residential purpose buildings, things like children's homes, care homes, that kind of thing. We've looked at something last week for forces homes, which would fall into the same category of relevant residential purpose buildings, but also relevant charitable purpose buildings, and that kind of identifies community centres, scout huts, etc. And just on that point, if you do have the scenario where you want to use a trading company to operate these premises, the approach might be then to have the charity build it, qualify for 0 rating on the building work, and then rent it down to the trading subsidiary to operate, because obviously the trading subsidiary doesn't qualify. So, and there's a way out of it, but you need to be thinking about the facts and how you actually want to operate it. More general ones: construction of for DDA works, disabled access, widening doors, creating ramps in existing buildings, that qualifies. Advertising, that's a fairly easy one for most charities, that if you're advertising anything in somebody else's medium, then that can be 0 rated with a certificate. So you would provide a certificate to the advertising person. And one of the areas we've seen quite a lot of oversight is on advertising for recruits. So if you're looking for staff, placing an advert, that can be 0 rated with a certificate to the provider. And aids to the disabled people, including vehicles adapted for disability, medical appliances, wheelchairs, and so on. So there are things there that naturally qualify for 0 rating in the charity. And the reduced rate is available for non-business use of fuel and power. Again, this is an area where we've seen clients say, well, we get 5%, and we've told the supplier we qualify by certificate. So they give them a certificate, perhaps not really understanding what non-business means. And non-business in this context is doing things that are not charged for. So if you run a community centre that nobody pays to go into, that's a non-business activity. If you run a community centre and you're charging people, that's probably more business-like. So it's really important to understand that if you think you qualify for 5% for fuel and power, that you understand why, and that you've given the right certificate to the energy supplier. A couple of other final things. When you rent properties into the charity, if the landlord wants to charge VAT, you do have an option to try and disapply that if you're using it for a non-business purpose. So a charity which might perhaps just receive donations is non-business, and it could ask the landlord to not charge VAT on any rent that's being charged, which is fine for you, the charity, but may be a problem for the landlord. So there's usually a bit of a discussion about whether that's in the best interests of all concerned, and there can be a bit of a haggling about if you have to pay VAT, you might pay a bit less rent because of that. A final little one, I'm not sure if anybody's online from church organisations, but there is also a grant scheme that effectively makes good the cost of VAT on repairs for listed churches, generally speaking, for public worship. And I've left the website page on for that. So it's something that might change in the future. Actually, that's a scheme that was introduced because we were in Europe, we couldn't go and provide zero rating. So the government got round that by providing a grant scheme to effectively provide zero rating, but through a grant reclaim scheme. So that's available as well. So those are the general reliefs for charities. Again, just to emphasise, that's available for charities, not trading companies. So if you're thinking about that work between the two of them, that's how you need to organise yourself to get access to those reliefs. I think that's the last slide. So with that, I'll hand back to Keith, and he'll deal with the Q&A part. Keith.
Thanks, Alan, and thanks, Susan, for working through those. I'll apologise in advance if there's any background noise. Who knew when I booked a room in an office block that the window cleaners would be choosing to come and wash the windows just at the time I was in here. As I say, just before, I don't think at this point, stunned into silence, perhaps no questions through in the box, but feel free to come up with them. But I'll probably lead off with a couple just to recap on a couple of key points there. I think we've obviously kept this at a fairly high level across sort of key things to look out for and be aware of. Interested, Susan and Alan, both of you, do you think there is still a tendency in the sector to think, we're charities, tax doesn't apply, we're exempt, or are people maybe getting more aware and aware of the need to ask for help, but because maybe just the rules and the complexity of some of those, they need to come for assistance. So interested in your views on just the overall awareness in the sector.
Yeah, I think it does probably vary from charity to charity, I would say. I think it is common for the trading threshold to be exceeded, but this isn't realised until too late when the statutory accounts are being prepared. So what I would say is important to monitor the trading activities that charities are doing throughout the year and consider it against the thresholds as you go along. And I would also say that when you're looking at your future plans for the year ahead, what kind of trading activities are you planning to do and what do you anticipate the income from those to be? And then if you are expecting that will exceed the relevant threshold, then that's kind of the point you'd want to look at setting up a trading subsidiary. How will we be affected? What activities will be put in the trading subsidiary, and any kind of VAT considerations and anything else to be looked at that point.
Mm-hmm. And I mean, I would agree. I think certainly on the VAT side, I see change as the big thing. You've sometimes got to change the legislation, and obviously the change of threshold this year is an example of that. But often it's the change of people. So if people have moved out of jobs and we're kind of on top of VAT, time can change, time can pass, and things just kind of drop off the list. So I would obviously always say anyway, but VAT on the risk register should be a feature for trustees just to keep an eye on. It will apply more to some than others, but it's always something to be thinking of. And I always start from the point of view that whilst most people think that VAT is a risk, it's also an opportunity. There are some reliefs out there that people can get hold of. Particularly, I mean, thinking about the one that we've just had, where we've got a retrospective 4-year claim, that they're completely blind to it. So with significant funds to the charity, which is really positive news for a change.
Yeah, absolutely. So some risks, but also some opportunities. If through proper planning, I think is what's coming out from everything that you're saying. Just to pick up on Susan, I think you touched on sort of tax consequences when you get into kind of non-primary purpose trading, and ideally, obviously, making profits. You didn't maybe touch on, you know, when maybe things don't go so well, if there's losses involved in those trading subsidiaries. Maybe you want to just expand on that a little bit.
Yep, of course. So losses unfortunately can be problematic as well for tax purposes. So if there is loss-making non-primary purpose activities, that can be seen as non-charitable expenditure, as the charity is effectively funding those losses in the trading subsidiary. And what that means is the charity can lose its tax exemption on an equivalent amount of income, so an equivalent amount of income to the loss that's been made by the trading subsidiary. This isn't something that necessarily happens immediately. HMRC would typically expect loss-making activities to be returned to profitability within 2 years. Otherwise, they'd expect the trustees to be considering whether they should continue with those activities.
Okay, so again, some key points there to really keep on top of and just be making sure you're monitoring what's going on.
Yeah, absolutely.
Yeah. I'm still waiting to see if anyone's wanting to ask a question. Alan, maybe for me and the uninitiated, how do you tell the difference between a grant and a supply for VAT?
Ooh, we've only got 5
Well,
minutes
yeah,
left.
you've got.
So, and this is another area where we spend a lot of time, and it's really important to ask yourself what the question is: what's the difference? The answer is the substance of what you're doing, and also the agreements that are in place. Normally, from a VAT point of view, a supply is where something is done for consideration or for consideration's worth. So the agreements typically help you, but also the substance of arrangements. So is somebody doing something for you, and are you paying them for it? Or in the case of grants, more often than not, it's a slab of money from a good source, typically a local authority or a trust or something, that says, here's some money, do some good things. We don't need anything in return for that. And that's that kind of break of the quid pro quo, that the connection between consideration and something in return. Here's some money, we don't need anything back, is more of a grant scenario. Yeah. And that within that, there's kind of small print in terms of they probably do want something in return just to prove that you didn't go and spend it down the pub. So there'll be some kind of good housekeeping, but that doesn't break the fact that it's still a grant. You know, if you've got little bits of grant housekeeping conditions in there, that's fine. But anything more substantive might be more of an indication of a supply position. So it's all about the detail, is the answer.
Sorry, just at this point, they are absolutely washing my windows. So I think there's one question coming through about questions on, you might ask, if you were not sure if you set up your trading subsidiary and the main charity correctly. I'll pick up that.
Okay, so I suppose that would maybe just be looking at the structure, first of all, that you use. So I suppose if you've got a charity, a company limited by guarantee, or maybe a scheme, and then that charity then has a trading subsidiary underneath it, which would be a company limited by shares. So that would be kind of the first thing that I'd be looking at. Is it set up that way? And if so, that probably sounds to be the standard way you would want to do it. In terms of kind of what activities are where within the charity and the trading subsidiary, I think that is definitely something that is worthwhile to look at. So ideally, you would want to have your trading activities in the trading subsidiary and only the trading activities. So you'd want to have any exempt activities within the charity. And that is just something that makes sense, because you wouldn't want to put exempt activities that would be exempt within the charity into the trading subsidiary, and then risk tax becoming payable on those in the trading subsidiary when they could just be in the charity and be exempt. So that would be kind of the first two questions that I would look at. What's the structure that you've got in place? What kind of entities are you using for your activities? And what activities have you got in each, and are they in the right place?
And that's mirrored in VAT terms, particularly the nature of the VAT supplies that you're making, you know, that you need to be clear on each, why each is in each entity, and there may be pros and cons to either approach.
Yes, I hope that's answered the question. I think from the presentation, Susan, one of those kind of it's maybe around that ancillary work and the ancillary trading where there can be a wee bit of judgment between which entity things should be sitting in. Maybe the old traditional view of charity trading subsidiaries, it was very clean in terms of the activities being undertaken. But as things have developed, you quite often get quite a mix of activities being undertaken in subsidiaries, and just being able to keep track, particularly of that. I think just as a small follow-up there is about the importance of staff allocation and matching the activities in each entity. I think that's probably something you've talked about both from the VAT and the staff don't need to be in each entity, but you would be reallocating the costs, or you could be having the staff sitting individually in each entity as well. So again, it's all about structure, if that's fair.
Yeah, I think the ancillary point is a good point. Like you said, in the past, it might have been quite clear something was obviously trading if it was, a gift shop selling things that are unrelated to the charity's purpose. Whereas now, I think charities are in the position where they're having to do a lot to try and raise their own funds. So they're maybe starting up trading activities that they maybe don't realise are not exempt in the hands of the charity. So again, it is just worth keeping everything that you're doing constantly under review.
Okay. I think we don't have any open questions at the moment. Maybe just one wee point, Alan, from what you talked about. You talked about the advantages, disadvantages potentially of VAT grouping. Is there any other way to avoid, and I use the word avoid carefully, to avoid VAT on recharges between charity and a trading company without grouping necessarily?
Yeah, the most obvious way of removing VAT as a potential cost is VAT grouping, but often there are other things at play. So one of the other approaches we can take is to have joint contracts of employment. So the staff are employed by both the trading subsidiary and the charity, which generally speaking is fairly straightforward to work. It can be quite a challenge if there are if the trading activity is perhaps in the retail trade where staff have typically different terms and conditions than the charities, and therefore there can be a bit of a discussion about whose pension scheme you're in, or are the T's and C's exactly the same. But generally speaking, those can be worked around. And I suppose the other thing is around control. So who's your boss? Is it somebody in the charity or somebody in the trading company? And again, with good governance and kind of clear structure, that can be resolved as well. But that's a really flexible way of just removing VAT as a question from staff recharges.
Okay, certainly one to bear in mind there, and probably quite relevant to the topics and questions we've just covered. So I think there's at this point, I suppose we've been open. I was about to say open for questions, but just one through. Is the question: is there a threshold for trading activities being done in the charity, i.e., shop in a library, which is under the threshold of 84,000, and so can be done in the charity?
Yeah, so I think that goes back to the slide where I had the table that had the different levels of income, where you look at the total income in the charity, and then if it's over 320,000, then up to 80,000 of non-primary purpose trading activity can be carried out within the charity. So it does depend on the income of the charity, but if it's a larger charity, then it would be the 80,000 that you're looking at, and that's allowed to be done in the charity, and it's not subject to corporation tax. And then for smaller charities, you have the thresholds of, if it's under 32,000, then the threshold is 8,000, and then if it's between 32,000 and 320,000, you then have to look at 25% of the charity's total income, and then it needs to be below that figure.
Yeah. Okay, so yeah, if you're anything over 320,000 of income, you're stuck at that ceiling of 80,000 basically for
that's right.
For it. but
Yeah.
below that, you've got a bit of a sliding scale downwards.
Yeah. And what I would say is that 80,000 hasn't changed. Certainly in the last few years, I think the last time it changed was maybe definitely a good like decade ago now, I think. So it's something that we'd probably hope would be changed, especially with what inflation's been like, with something we'd hope would be changed quite soon. But I suppose the government's probably got a lot of priorities at the moment, so maybe just haven't got to that one yet.
Sure. Okay. Thanks for picking up on those. Yep. Got them dealt with. So I think at this point, maybe no more questions coming through that I see. We're on kind of 41, 42 minutes. So I suppose my target for the chairing was to deliver within the 45 minutes that we said. So we're pretty much on schedule for that. Assuming we get no more questions, and if anybody does kind of push anything through late, then we'll certainly pick it up and send it out as part of the recording as well, which will circulate. So I think we'll just proceed to wrap up at this point. I'd like to thank you all very much for dialing in to listen to the session this morning. We hope we haven't scared you necessarily, but have flagged that there are some opportunities. But basically, good planning and a bit of an awareness of some of the key, as I say, risks and opportunities is the way forward. The next session we've got will be scheduled in for June, and we'll be considering trustee responsibilities, particularly when the finances get very challenging, so as to be aware of what your responsibilities are at those times. And the advertising for that will come out in due course. So thank you again for your participation, and have a good day.
Thank you.
Thanks. Bye-bye.